Thank you very much for the invitation. So it is a nice paper in the intersection of, let's say, sort of macro finance and market microstructure. There are few of this genre, I will say. And because the object they're interested in is the sovereign debt, right? They look at the sovereign debt around those auction periods. And the model they have in their mind is coming from market microstructure, is an inventory-based model. Well, as you can see, this title is a bit long. Probably that will be the first suggestion to shorten it, maybe. There's a suggestion, actually. Well, you cannot see it there, but I had a suggestion there. Anyhow, so in a nutshell, what we have here, the authors look at the auction cycles in the EU, okay, 6 countries, and they compare the domestic auctions versus the foreign auctions, in particular the effects of the foreign auctions on the domestic market auctions. They have an earlier paper on the domestic market, especially on Italy and Germany. And in this case, they extend the sample to 6 countries, right? And the major focus, I think, this time is mostly on the spillovers, right? This is the more, let's say, the novel part. It's not a theoretical paper. It's purely empirical, I would say. But they have a motivational, let's say, illustrational model in terms of Hohenstall, let's say, inventory type of model. And the empirical analysis is based on event study. And of course, they do some robustness checks using the regression analysis. And they divide the group in the post and pre, and they have findings, different findings in the post and pre-crisis periods. Okay, so the data is, as far as I understand, is the second market data, right? You don't use the primary market. Okay, and 6 countries over the entire period of Euro, let's say. And most analysis with the event window is 5-day. I think Massimo didn't mention that, but this is in line with the sort of the half-life of inventories in this primary dealership market. So it's roughly 2.5 days. And the major contribution, as I said, is on the cross-country effect. So let's start with the theory. The main idea is that the primary dealers are, first of all, they are risk averse, captured by the parameter A, and this risk-taking capacity is sort of limited. Okay, so the main intuition, Massimo already had this slide before, so I won't spend much time, but to me the main intuition is like before the auction, since the dates are anticipated, right, they know that they will build up some inventory in the auction, right, so the I goes up, and then this is sort of a mispricing if you think. So there's the fundamental value, the price, and the mispricing is related to the risk aversion and the level of inventory and this sort of the covariance term, right, between the assets. In this case, the sovereign bonds. So the price goes down and the yield goes up, right? And the opposite effect after the auction, what you see is that basically the dealers get rid of their inventory, then the prices go up, and the opposite effect. That's why you see the inverse V shape. So this is one of the paradigms you would use if you use a microstructure model. You will pick sort of an asymmetric information type of model if you're interested in permanent effects, right? Or an inventory type of model will rationalize, let's say, temporary effects in the market, right? And the temporary effect, because we know that the dealers, these guys, the big banks, they don't want to keep large inventories, right? So the inventories are mean reverting in a way. So if there's any effect, it should be temporary. All right? So there are other alternative theories Massimo already mentioned. For instance, the supply side. Of course, there's the auction, a new issuance that will change the composition of the outstanding debt. So there's the new issue and old ones. So this is also related to the on-the-run, off-the-run concept. Those bonds that are issued before, they become off the run, and the new ones become on the run. And there are a couple of papers showing that there are liquidity effects on the on-the-run and off-the-run effects. Okay? So one of my key comments probably will be related to this persistence versus temporary effect, right? So they argue that the effect they see is temporary, which is probably the case, and especially the part where they show that this effect is symmetric statistically. But I don't think it's the case everywhere, right? So I don't see why it should be sort of mutually exclusive. And they don't discuss much the liquidity effects in the market, in this particular case around the auctions. And we have a couple of papers where they show when there are such events in the markets, like news announcements or auctions, there's sort of the calm before the storm effect, so there's not much trading, so yields might go up because of that. And after the auction, the yield might go down again. So this is an alternative theory. So first suggestion would be sort of trying to explicitly take into consideration some sort of liquidity effects in the market, right? And I don't think that will harm their story. It will complement it, because we know that the story works in some cases, but in others, of course, it's an empirical, so you don't always see this perfect shape in all the countries, but this will never happen, right? The other thing is, like, these guys, the market participants, these are the banks, the usual suspects, and they have a one-period model in mind, but they play a repetitive game, right? They enter into these auctions all the time. So you would expect them to act sort of strategically, right? And that probably, I know this is not a theory paper, but they might consider in the theory that the way they act in the market might sort of also be reflected in the prices, hence in the yields, right? And also, we know, at least from the other markets, for instance, foreign exchange market, the dealers are quite active trading with themselves as well. There's not much discussion in the paper, but what about interdealer trading? So what is the hedging activity in the markets? Because we say that there is limited risk bearing, right? But there are some hedging tools available for the dealers, I suppose, also in this market. So that will sort of have the opposite effect on the theory they have in mind. So I think that a discussion on that side would also be useful. And finally, there is not much talk about the end investors in the market. So in the secondary market, who are the guys buying, right? Like hedge funds, mutual funds, are these guys arbitrageurs? So because we're talking about a temporary mispricing, right? So maybe this mispricing, if there are arbitrageurs, can be eliminated. So what is the role of these other guys? And in the other Lu paper, which is focusing mostly on the US case and no spillovers, right? In that paper, they also have this imperfect capital mobility argument, which you don't talk about, and I was wondering why. Yeah. Okay. So the reversal, I already mentioned that. So is there really a reversal? Yes, it goes to the same level, maybe but in some cases it doesn't. But you already said that you tested it with the symmetry property, and it seems to be, at least in the cases where they have significant results. So sample split, pre and post crisis. Well, yes, the crisis in the US started in July 2007, but we had a sort of a bigger crisis in Europe. Why don't you focus also on the, let's say, European sovereign debt crisis starting maybe from early to 2010, right? And you might get stronger results. Clearly, we are in two different worlds, right? Especially in terms of betas, you have this substitutability parameter, which was all in the region of 90. So this is basically, if you plot the sovereign debt yields across time series, you'll see until the crisis, all the yields are very much the same, right? You cannot really distinguish them, as if there is one single Eurobond before the crisis. But after the crisis, you see all the spreads, right, relative to Germany. And actually, this table tells you exactly the story. For instance, Spain, Italy, you see the correlations become in the range of 10, 15 or so, right? I call them correlations, but the measure they have the beta here, right? So there are different effects here. One of them, especially the spillover effect they find in the crisis. So yes, during the crisis period, these correlations go down, true, but the risk aversion, you argue is going up, right? So in opposite directions. So which one prevails? We don't really know. What about sigma, right? So maybe sort of a bit more discussion on that would be useful. This counter effects, right? Well, on the empirical side, you already went through in detail the event study and regression part. I was just wondering whether you looked at the yield spreads as well, let's say, relative to Germany, because most of the cases the market participants are also interested in spreads rather than the levels. And whether we see a similar pattern if you look at the spreads, any effect. I was just thinking whether there are alternative ways sort of identifying this cross-country spillovers. exposed thinking, okay, changes in credit ratings, you don't have many events probably. In the crisis period, you had some Italy, Spain, but these are just few. But we had many news about the Greek exit, right? Periods of, let's say, the likelihood of Greek exit changing. And maybe you could relate it to those, because Greece is not in your sample, so check how that would affect the auction yields, right? And also you show that the spillover effects are stronger in some maturities, especially 30 years. I was wondering whether sort of a preferred habitat theory could justify that, meaning that there are sort of type of clients in the market, they are interested only in particular maturities, right? So maybe that could help to justify. This is just one curious observation in case of Belgium. So this is the plot where you take into account the volatility, the crisis intensity, and we can see that the blue one, the Belgium, is kind of the most volatile one. And I was wondering whether it's related sort of maybe the Belgian political crisis we discussed in the morning, right? That there was no government for a while. And well, it's just, maybe you can comment on that. It's nothing so important. So the important part is sort of the policy implication. Especially you spent some time on debt issuance cost. I still have some issues, but probably this is my misunderstanding, like how this secondary market cycles will really affect the issuance cost, because as far as I understand, in the primary market, the government trades with the dealers, and the dealers go and trade with the others in the secondary market, and the effect you show is in the secondary market. Why would it cost? But
I don't say, I don't know, I can, as a kind of, if it acts, if the secondary market yields acts as a benchmark.
Right.
Suppose, you know, the auction is at 10:30 in the morning.
Right.
And in the morning at 9 or the night before, you go to the secondary markets with price at a certain level.
Okay.
When you plot the two, because we also at the years, the two are highly, so that in this literature there's kind of an assumption that, you know, is the latest price in the secondary market.
So that's the price at which you borrow. Fair enough. Okay. So there are cases, of course, where we don't see those strong cycles, especially Germany and Netherlands. That was the point of the other paper as well. So I was wondering whether it's related to the, let's say, the auction mechanism, right? You briefly mentioned the step auction. But I think you can talk more about that, because Netherlands is one case where we don't see it strong. So one policy implication, is it related to the auction mechanism? So shall we change the auction mechanism, right? And the other point is, in those countries, what is the issue? That there is less inventory risk, or the dealers in those markets are less risk averse, or they better manage their inventory? What is the story, right? I mean, I think you rationalized, let's say, the case of Italy, but you can discuss more those cases where it doesn't really work, right? And also alternative solutions. Shall we increase maybe the number of primary dealers in the market? Would that possibly solve the problem, this mispricing, or introduce other hedging instruments to primary dealers? And finally, what is the role of the ECB? Let's say you don't talk much about the primary in the money cash market, right? So there are papers also showing that the ECB is quite active in injecting money, right? So, well, and in this, what is the effect on the action in the auction of the long-term bond yields, right? I think, yeah. Final remarks. Interesting. There's a lot of information in the paper, many results. Of course, we didn't have to go time. We didn't have enough time to go over all of them. Simple intuitive model, but I think it has to be a bit more developed to explain this different features of the market. Nice domestic versus cross-border effects. I will mainly focus on the cross-border side, because you should differentiate, I think, the paper from the earlier one. That will be the key challenge, right? So focus on contagion and spillover. And finally, let me share the morning's dream, the dream of this morning, Paul's dream, right? What if there's a fiscal union, let's say, right? So the implication of your finding is then during the crisis period, we should see stronger cycles, right? If you just imagine that we only had one single Eurobond, right? So in that sense, that will cost a lot of extra.
Why is the crisis?
Well, we said in the capitalistic world, we will have the crisis, right? That's known. So anyhow, thanks a lot. That's it.